Let us start with study session 18, Alternative Investments. Reading 66 is Introduction to Alternative Investments. Under this LOS, we are going to understand open-ended and close-ended funds and the differentiation between them. We'll also understand the concept of net asset value for a fund. Then we look at the types of equity funds, exchange traded funds, and their advantages and risk. We'll also examine real estate investments and their characteristics and different approaches to this kind of valuations. We'll also look at different methods to calculate the net operating income from a real estate investment. Then we look at the concept of venture capital and the calculation of NPV for a venture capital project. Then we look at the hedge funds and their characteristics. We'll also understand the concept of funds of fund, the unique risk associated with the hedge fund and the biases associated with the hedge fund. Then we'll explore the legal concerns associated with the closely held company. And for these companies, we'll look at the valuation discounts and premiums. Another class of investment is distressed securities. We'll understand how they are different from others. Then we'll compare venture capital investing with distressed securities investing based on their characteristics. Finally, we look at the investment in commodities and collateralized commodity futures position. So these are all the venues for alternative investments. Let us start with open-ended and closed-ended funds. The open-ended funds do not have a fixed maturity period and they are traded continuously. The investors can buy or sell their units at any particular day at the NAV, which is calculated for a particular business day. There are certain fees which are charged on purchase or sale of the fund. They are called entry load or exit load. There are some funds which do not charge any fee and which are known as no load fund, since there is no entry load or exit load. There are certain fees which are to be paid, whether it is a load fund or no load fund. For example, in United States there are 12B fees which are to be paid. Another important characteristic of an open-ended fund is that it cannot be sold short. So it can be only sold when the investor is holding it. Now let us look at the close-ended funds. These are the funds which have a fixed maturity. They are traded on organized exchanges, for example S&P, and the liquidity is determined by the day-to-day movement in the secondary market. For that, a small premium is charged for the compensation for issuance. Another difference with the open-ended fund is that the concept of load or no load fund is not applicable here. There are certain management fees which are charged, and closed-ended fund can be sold short, unlike the open-ended funds. So these were the basic difference in the characteristics. Now let us move to the next concept, net asset value. We look at the mechanism to calculate the net asset value of a fund. So net asset value or NAV represents per share market value of a particular fund, which is nothing but assets minus liability for that company. For example, if the fund has $50 million assets and $10 million liabilities, so the difference between these two would be net asset value or value of equity, $40 million in this case. So the price of an open-ended fund, which we have just seen, always depends on NAV, because the investors are obligated to redeem the shares at current market price. The price of a close-ended funds can be up or below NAV, as the price is determined in the secondary market, since the number of buyers and sellers are going to determine the value of the fund in the case of close-ended fund. But in the case of open-ended, the price is always equal to net asset value. So if you want to calculate NAV for a particular fund, we can simply have assets minus liability divided by number of shares outstanding for that particular fund, so which is our NAV per share. Now let us move to the next concept, which is the types of equity fund. There could be various kind of equity fund. For example, it could be a style fund which is focusing on a one characteristic of asset. For example, it could be growth fund or value fund if it is focusing on growth stock. So it is one kind of style for a fund, or if it is focusing on value stocks, then it is called value fund. So that is based on the style. Then we can have sector fund, a fund which is focusing on a particular sector, for example, IT sector, pharma sector, or FMCG. So it would be a sector specific fund or sector fund. Then it could be an index fund, which is nothing but mimicking the index. So all investments are based on the movement of the index. So if the index moves up, the fund gains. If it comes down, the fund also loses, but because it is replicating the index. Another kind of equity fund is global fund, which involves the strategy of investing in securities in global economy, which includes the home country as well as foreign locations. Another category is stable fund. These kind of funds ensure stability based on safe investments. For example, government securities, T-bills, etc. Since they are extremely low risk or risk free kind of investments, they try to provide stability to the fund. Let us move to the next slide. Exchange traded funds. These funds are very similar to closed ended funds as they also imitate the performance of a specific index. The fee structure is lower, and another characteristic is that they can be shorted or margined. Since they are similar to closed ended funds, they can be shorted. Another unique features of exchange traded fund is it has in-kind redemption feature. So that keeps the price of exchange traded fund close to the net asset value. Another important aspect is the tax liability of the investor is lower in the case of exchange traded fund. Now let us look at the advantages and risk associated in detail for ETFs. Important advantage of ETF is that they are tax friendly investments because the capital gain tax is less. Another important advantage is that they are traded in a similar way as stock index, and they can be traded intraday, shorted or margined. So these are the advantages over open-ended funds which cannot be traded intraday. Then the underlying assets are published daily. If there is any change, that can be noticed immediately. The operating expense ratio is lower in the case of ETFs, and since in-kind redemption is used, that helps in keeping the price close to NAV. See, in-kind redemption means that instead of giving cash, those stocks can be transferred to the account of investor. So that will help in keeping the price close to NAV, which will be nothing but the value of all those assets. And in some of the ETFs, dividend can be reinvested immediately. So if the excess cash is there with the investor, that can be put back to the fund. That is another advantage. Now let us move to the disadvantages of exchange traded funds. One major disadvantage is that there are few ETF indexes around the world which affects the price of some mid cap and small cap stocks in a particular portfolio. So there is a causal relationship from ETF towards mid cap and small cap stocks. Then the intraday trading feature which is available with the ETF may not be suitable for long term investors, since many investors who are buying index funds may not be interested in intraday trading because they can achieve it through futures and options on the index fund. Generally, the trading volume is low, so bid ask spread is large, cost of buying or selling is higher. Another disadvantage is that the large investors can directly buy the portfolios themselves, so they do not need to buy an exchange traded fund. So that way ETF is not useful. Now let us look at the risk associated with the ETF. So most important risk is market risk of the index which ETF is following. The second is that trading prices may vary from the NAV because of the liquidity issues and the depth in the market. If there are no sufficient number of players available, then the variation from NAV could be higher. There is a possibility of high tracking error risk, because of which the portfolio becomes slightly different from the index. This kind of risk arises because the lot sizes are fixed. We cannot buy a fraction of the lot size. So the exact replication of index may not be possible for a small size of fund. So there is a tracking error which would arise. There is a leverage and credit risk if the derivatives are used. There will be asset class and sector risk if it has been a sector specific index which the ETF is following. And then if it is an international indices based ETF, then there will be a country risk or currency risk associated with that. Now let us move to another kind of alternative investment, the real estate investment. This is one of the most common tangible assets in which investors can invest. It can be broadly defined as land plus any permanently attached fixture. So these kind of invests are fairly illiquid, so they cannot be bought or sold at a very short notice since the liquidity is low. There are mainly four kinds of categories for real estate investments. Fun, First one is outright ownership, where the owner is owning the asset and which is free and clear equity position. The second category is leveraged equity position. It is similar to outright ownership. The only difference is some type of loan has been taken in order to buy a asset. Third is the mortgage, where the investor who is holder of the loan receives monthly payment from the borrower. So in this case, if the borrower defaults, then the investor has a risk. And to compensate that, he has been provided the right to acquire the asset. So if the borrower is defaulting, the investor will be acquiring the asset. So this risk which these investors are going to have is to be hedged by investing in different group or large pool of mortgages. The fourth kind of vehicle is aggregation vehicles, which help investors to diversify their portfolio by investing in a group or pools of project, where the investor is not buying one particular property, but they are investing in a pool of different properties. For example, commingled funds, real estate investment trust, REITs, which are very common. Now let us look at the other characteristics of real estate investment. First, they are not movable assets, they are fixed at one place, or immovable assets. Since every real estate investment asset is different, or we can say property market is heterogeneous, the direct comparison of one property with another cannot be made. So their pricing is always going to have some kind of subjectivity since they are unique. They are all illiquid investments. There is no ready market available for buying and selling. The transaction costs are high and the management fees are also high. Since the information is asset specific, it is not readily available, which makes the market inefficient. Also, the real estate investment do not have many indices that makes it difficult to value an investment in national and international markets. So we do not have sufficient number of benchmarks from where we can compare. That makes valuation very challenging. Now let us look at various techniques for valuation of real estate investments. Broadly, there are four approaches for real estate investment valuation. First is the cost method. Under this method, the valuation is done based on the cost of land plus any improvements done. And our valuation is based on the current construction cost. But since there are limitations of this cost method, the market value may differ from the replacement cost. It is not necessarily that the market value of the property is going to same as a replacement cost. And that is why the valuation of property is not easy using cost method. Let us look at the second method, which is sales comparison method, under which we have similar property prices or some recent property transaction which is used to compare the price of the property. So if we have certain similar property for which the transaction has occurred in recent past, we can compare and then we can make certain adjustments based on the differences in the current property, and we can find out the value of the property. But if the market is very illiquid, there are no sufficient number of transactions in near past, then we cannot use this method. And since the properties are heterogeneous, the different features of different properties may not reflect the true value. And under this approach, the market value is estimated relative to the benchmark. So there is a refined version of this approach which is called hedonic price estimation, in which we have the features and recent price transactions, and we are building a regression model between them to find out a specific relationship so that we can compare it across the real estate investments of that type. Let us look at another method, which is income approach, under which we are going to look at the possible incomes from that property, and all those incomes are discounted to present value to estimate the value. To find out the cash flow, we have net operating income, which is nothing but the difference between the rent revenue annually and the operating expenses. So this difference will give us the net operating income, and then we can use as a benchmark for another property. The appraisal price is net operating income divided by the market capitalization rate. This is one rate which will take care of conversion into present market value. So we have one simple ratio, market cap rate, which will give us the idea how to convert the annual net operating income into present value. For example, we are not calculating the exact present value. Let us take one example. If there is property A where the annual rent expected is say $200,000, while there are operating expenses say in maintenance etc., which are $50,000. So we know net operating income per year is the difference between these two, which is $150,000. Now one way is we have these cash flows for all the future years possible, and then we discount it to present value and sum it up. And another method is we find out just the ratio for property A. Suppose we know that the value of this property is $1 million. So we know the market cap rate is $150,000 divided by 1.5 million. So it is going to be 0.1. This is our market cap rate. So now if there is a property B which is of similar type, and where suppose net operating income, which is rent minus operating expenses, say $100,000. So based on the same ratio, we can find out the value, which is NOI by market cap rate. So $100,000 divided by 0.1, which is $1 million. So we can find out that the value of this property is $1 million based on our market cap rate. So we can find out for one particular property and we can use it as a benchmark for other property valuation. Now let us look at the final approach for the valuation of real estate, which is discounted cash flow after tax. Here we link the value of property to an investor's specific marginal tax rate. Every investor has a specific marginal tax rate. So that way we are going to use only the projects which are positive NPV. Otherwise, it will not make any financial sense to invest in that property. Here the net asset value is going to be equal to the present value of after tax cash flows. As we have seen in the last example, we are having the future cash flow, net operating income, but we were not discounting them because we are using a ratio there. But here we are going to have after tax cash flows divided by the required rate of return minus the equity part of the investment. So this is our NAV. This calculation is very similar to net present value in corporate finance. So this is our investment, the cost or the equity, and this is the final value discounted to the present value. So this difference is our net asset value. If it is positive, then we are going to invest in that particular asset, otherwise no. Now let us take a few numerical examples to understand these various approaches for real estate valuation. This net operating income NOI is calculated by subtracting vacancy period. If there is a property which was not occupied all the time, there was certain vacancy period, then that has to be adjusted in the net operating income. If there are certain collections or there are certain operating expenses or maintenance expenses, then those should be subtracted from the gross operating income in order to find out the actual net operating income. So in this example, the NOI has to be calculated given that gross rental income from that building is $700,000. There is a vacancy loss of 10%, which says that 10% of the times the building is vacant. So no income is coming. There is a tax liability of $10,000. There is an insurance cost which is $10,000. Another utility and maintenance cost is $35,500. Now we have to find out net operating income, net of all the expenses. So there was gross rental income 700,000. So 10% is vacancy loss. So minus 10% of it, which is $70,000, minus tax liability $10,000, minus insurance cost, which is again $10,000, minus utility and maintenance cost, which is $35,500. So net of which we are going to have net operating income. If we calculate, we get $574,500. So this is annual net operating income. So every year this is the net operating income from this building. This was a calculation. We get $574,500. This is net operating income. If the sales comparison approach is used, which is based on the sales price of a comparable property where the actual transaction has taken place. So the valuation is based on the benchmark, such as mean prices from all such transactions in the vicinity. Then we have addition and subtraction. For example, if it's a premium property, for example, it is close to metro station, then there are additions. If it is a non-premium property or there are some negative characteristics of the property, say it is near garbage dump ground, then we have certain subtractions from that value. So we have hedonic price estimate, which is to be used for valuation of these characteristics, and we put them in model, and finally we can calculate the expected price of the property. For example, if the property is 5 miles away from a metro station, then we have to subtract this. If the effect is $3,000 per mile, then 3,000 into 5, $15,000 have to be subtracted from other properties which are close to metro station. Another approach is income approach, where we look at the present value of stream of annual net operating income, and we use required rate of return or the specified market cap rate for that property, and from NOI we can calculate the value of the property. So we can use either required rate of return or we can use market cap rate. Using either of them we can find out the value of the property. Now let us take an example. Here we are going to use hedonic price estimate for sales comparison method. There is an office building which is sold recently in neighboring vicinity. So we can use this as a benchmark for all other buildings. Now an investor wants to compare the sale of building in hedonic price model to estimate the current appraisal of a building. So we are using sales comparison approach. The office is 1 mile away from the market, vacancy rate is 6%, and the size of the office is 55,000 square feet. And these are the characteristics given. Distance from the market in miles. And this is the effect on the property value in dollar per unit. So for distance, it is $75,000 per mile. Then vacancy rate of the building is 6%. For 1%, it is 30,000. So we are going to subtract it. Then the office size for $30 per square feet. So this is going to be positive. So based on the size, price is going to be higher. So 30 into 55,000 is positive. And since it is 1 mile away, so 1 into 75,000. And since 6% is the vacancy rate, so minus 6 into 30,000. So this is how we get the value of the property. 75,000 into 1, this is due to distance. 30,000 into 6, this is due to vacancy. And 55,000 into 30, this was the cost. $30 per square feet, and it was 55,000 square feet. The cumulative effect is 1,395,000. So total about $1.395 million. This is the cost, value of the company. Let us take another example. Again, we have to value the property based on net operating income and market cap rate. So we need to first calculate the net operating income, and based on the market cap rate, we can find out the value of the property. So gross rental income is given, vacancy loss is given, tax liability and insurance costs are given, utility and maintenance cost is given. So we have already calculated based on them what is NOI, which was 700,000 minus this was due to occupancy loss or vacancy loss, then the the insurance cost, the tax cost, and utility and maintenance cost. So all of them have to be subtracted. So we get this much net operating income, and the market cap rate is already given. So we can divide the net operating income by market cap rate and find out the appraised value of the property, which is 10 times. Let us look at the valuation through one more method, where the investor is purchasing a building for $1,750,000. 20% is put in cash. So equity is just 20% of that, which is $350,000. This is the equity, and rest of it is loan. So loan is $1,400,000. So this is loan, this is equity. Total is the cost of building. Now mortgage rate is 10%. So 10% of this is going to be interest cost, and the annual payment of loan is 146,997. So interest is going to be 10% of loan, which is $140,000, and rest is going to be the part of principal, which is 6,997. If we add these two, we get total payment on loan, annual payment on loan. The tax rate is given to be 28%, and there is straight line depreciation, which is estimated to be 50,000. So we need to calculate after tax cash flow, NPV, and yield on the investment. For that, we need to know what is the operating income, which is also given, 197,500. This is the operating income. So to calculate after tax net income, we need to find out what is the depreciation. For taxation purposes, we are going to subtract it, minus this is the interest cost, which is 140,000. So this is before tax income. Now we have 1 minus t in order to find out after tax income. So this is the tax part, which is subtracted. Finally, we have $7,500. So this is the after tax net income. But in order to find out the cash, we need to add back the depreciation. Since it is a non-cash expense, for taxation we need to consider, but otherwise for cash flows we have to add it back. So 7,500 plus 50,000, which was depreciation, minus 6,997. This was the principal payment. So as we know that 140,000 was the interest and 6,997 was the principal which was to be paid in mortgage. So we subtract that. Finally we have 50,503. This is for first year, the after tax cash flow. Similarly, based on the information given, we can find out for other years as well. Now for final value after 3 years, the investor is deciding to sell it for 1,850,000, that is 1.85 million. At that time, remaining mortgage balance will be 1,350,000. So which is to be paid. Assuming that the cost of equity is 10%, and based on the expenses, we can calculate what is going to be the net cash flow. So the expenses are not given. The overall cash flow is given here. So based on these three values, we can discount them at 10% and finally find out the value, which is $472,649. Now this is the value of cash flows discounted to present value, and we already know the investment or the equity was just 20% of that, which was $350,000. So if we want to find out the net present value or net asset value, it is going to be the present value of total future cash flows minus equity or the investment. So this is our net present value or net asset value. Since it is positive, this investment is worthwhile. We have another method which is IRR or internal rate of return, that also can be found out. So the first cash flow is negative, which is the investment, and the other subsequent cash flows are positive. So these are four cash flows based on which we can find out the internal rate of return, which is coming out to be 22.63%, which is clearly greater than the cost of equity, which was 10%, because of which this project was profitable, or we can say the investment in this property is profitable. Now let us move to the next topic, another alternative investment, which is venture capital. This is a private investment in which the entrepreneurs are investing in a startup business for seeking excess returns. Since these startup businesses are not already successful, but there is a potential for a great return in future, these private investment evaluate the business, and if they find it valuable, they invest, and later they get good returns. These venture capital firms acquire the investments from large investors, which could be institutional investors such as bank or private equity firm or pension fund, etc. So these large amount of investments are routed to startup businesses through these venture capital investment firms. These venture capital investment provide funding to startup companies at different stages. Let us look at those stages. First could be seed stage, where the idea has been tested but it has not yet come to the market. So this is just in seeding stage. Next comes the early stage, which has two phases. First is startup financing, which is for product development and marketing strategy in early phases. And then the first stage, which helps in building capabilities for commercial production and the sales of the product. This is the first stage. When we say formative stage, it is nothing but the combination of first two stages. It covers both the seed stage and early stage. So if venture capital is providing funding in formative stage, it covers right from the seed stage to first stage. After that comes the later stage, where the company is still private but it is trying to go public. So the idea has been already tested, the company has brought its product or service to the market and it is profitable, but it is still private. So it tries to raise certain funds from equity market, which is called later stage. So here we can have second stage investing, in which the company is producing and selling the product but still not able to generate profit, or it could be third stage financing, where it is helping for major expansion in the company. Company is profitable, but it wants to expand to different market or different segments. For that, venture capital is providing funding. And third kind is mezzanine or bridge financing, which helps the company to take certain steps for going public. So these were the stages. Now let us look at the characteristics of venture capital. First, this kind of investments are very illiquid since there is no proper trading happening in such kind of investments. Another, the investment horizon is long. The valuation is difficult since the data available is also very limited for a startup company. There might be a mismatch between the entrepreneur and the management. Entrepreneur may have a different vision from the management. Another characteristic is that the fund manager might be focusing only on incentive, whereas the entrepreneur has a long vision for the company. Timing is also very important as the returns will be based on that, and as it is clear from the nature of the investment, proper analysis is required for extensive research and management of venture capital. Due to these properties, it is one of the most risky investment since the probability of failure is high. The companies are a startup, they have not proved themselves yet. There is an uncertainty about the timing of the cash flow. So for a venture capital, there are three important factors which should be assessed before investing in a startup company. First is expected payoff at the time of exit, and what should be the timing of the exit, and what are the chances of failure. So these need to be evaluated properly before investing in a startup company. Now let us understand the valuation of a venture capital project. We are calculating the net present value of the project. The venture capital fund manager is planning to invest $5 million in a new project, and his analysis says that it will get $24 million at the end of 5 years. The cost of equity is given as 15%, and the estimated probability of failure, which is very important and needs to be taken care of, is given into the table. These are conditional probabilities since they represent the probability of failure in a given year. Now we need to value the project using NPV technique. So for first year, the probability of failure is 20%. The second year probability is 20%, which is the conditional probability that provided that it did not fail in the first year, what are the chances that the company will fail in the second year? That is 20%. Similarly, the conditional probabilities for subsequent years are 17%, 15%, and 15%. Now we need to find out the NPV. So first we have to calculate what are the chances that company is going to survive. The project will survive for next 5 years. So we need to find out that company survives in the first year, then it survives in the second year, third year, fourth year, and fifth year. So if the company survives all throughout the period, the probability is 38.379%. So that is 1 minus 0.38379. This is the probability that company will fail or the project will fail in these 5 years. So we need to find out the NPV in both the cases. So if it is a successful project, then NPV is going to be the initial investment plus $24 million, which the company is expecting to get after 5 years, discounted by cost of equity. This was cost of equity, 15%. So it is 1.15 to the power 5. So our net present value is $6.932 million. This we are expecting if the project is successful. But there is a possibility that the project might fail, and that probability is 1 minus 0.38379, which is 0.6162. In that case, all the investment is going to be lost. $5 million investment is lost in the case of failure. So minus 5 million into 0.6162, the probability of this loss, and this is the NPV if the project is successful, and the probability of that case, that is multiplied. So this is calculation of expectations. We know that we calculate expectations as sigma of probability into cash flow. So if we add this, we get NPV which is negative. This negative NPV signifies that the project is risky and the fund manager should not invest in the project. The net present value is negative. If the probability is not considered, then this NPV appears to be positive. But if we consider the possibility of failure and account for those probabilities into the estimation, then we find out that the NPV is negative and it is not worth investing in such project. So this is how the consideration of probability is very important while calculating net present value of a venture capital project. Now let us move to another kind of investment, hedge funds. This is one important category. The hedge funds seek absolute returns. They are not necessarily restricted or constrained to perform according to a particular index or benchmark. So their performance is measured not on relative basis but on absolute basis. Since they do not raise funds from public, they are exempted from SEC regulations in US, Security Exchange Commission. The name hedge fund says that the important strategy has to be hedging, but which is not necessary. They do not need to involve in hedging, though they may hedge their investment in different markets, and their performance fee plus flat fees charged from the investors. Performance based fee will be applicable only when the returns are over and above certain benchmarks. Flat fee will be charged based on the size of the asset. Generally, hedge funds are structured as limited partnership. So if suppose there is a $100,000 investment in a hedge fund, there could be a flat fee, say 2%. So that would be $2,000, and there will be a performance fee. So if the return is greater than 8%, then say 15% of profit will be charged as performance fee. For example, if the company has made say 20% return, then this performance based fee also is to be charged. Now let us look at various kinds of hedge funds. They can be classified in many ways. First, they could be long short funds, which is the largest category of hedge funds. They take long positions and short positions, which sometimes balance each other. Then there could be market neutral funds. Since they are market neutral, they are hedged against any general market moves upwards or downwards. They have taken a lot of long positions in certain stocks and a lot of short positions in other stocks, which are hedged against each other to make it market neutral. Then we can have global macro funds based on the macroeconomic conditions in different countries. So they look at the direction of currency, interest rates, and other macroeconomic factor in various economies. Then we can have event driven funds, which look for certain unique opportunities that exist in the market for a small period. For example, investing in a distressed company or certain cases. So these kind of hedge funds look at these events. Now let us move to the next slide. Funds of fund. As we have seen that investing in one particular hedge fund is more risky, so certain investors prefer fund of different hedge funds. So the benefit is that enables investor with limited capital to invest in hedge funds, since investment in hedge funds is of large quantity. So if there is a pool which is created for different hedge funds, then even small investors can invest in funds of fund, and diversification benefit is also provided to the investors since they are different hedge funds and they have different strategies. It also provides access to the closed funds, generally which are close to the investors because of high capital stake involved. Also the professional guidance on where to invest and where not to invest is given, so that is the advantage. There are certain drawbacks of funds of fund. First is, since a professional manager is helping in investing in funds, the management fee will be charged in addition to the fee which is already being charged. So there are fees which are involved in hedge funds. In addition to that, there is one more fee which is because of the professional manager who is running funds of fund. He is selecting basically the hedge funds. So that additional management fee is also involved. Another drawback is the diversification may decrease the risk of the investor, but the returns are also decreased. Since an individual hedge fund might give a significantly higher returns, but since the investor is diversifying the portfolio, the returns will also come down. Another drawback is a fund manager may or may not be able to deliver returns to an investor what he can achieve individually investing. That risk is always there. Now let us look at certain unique risk of hedge funds. First is illiquidity. One cannot transfer easily his or her stakes to some other investor. Second is there is a potential for mispricing. Since there are certain securities who do not trade that frequently, they might lead to problems in valuation of that particular security. There might be a counterparty credit risk since the broker dealer is involved in almost every transaction, so counterparty risk is prevalent. There could be a settlement risk that counterparty is not able to deliver the security on agreed date. There could be a risk due to short covering. There are cases where short positions are not covered properly. Then there could be margin calls on highly leveraged positions. So they can cause a situation of forced selling or selling at a high loss. So these are the risks associated with the hedge funds. Let us move to the next topic, the biases of hedge funds. So when we measure the performance of hedge funds, there could be certain biases involved. So when an investor is looking for a hedge fund, he or she needs to consider these biases and try to adjust for them. Hedge funds performance had better returns, lower risk, and higher Sharpe's ratios, but there are certain biases which we need to look at. First is self-selection bias. Since the manager cherry pick their funds, so the funds which have been performing really well, they are considered for evaluation, and the ones who are not performing well, they are not selected. So that is resulting in overestimation of the return. Second is backfilling bias. Since the manager only pick those funds in their index which have performed well and they do not include the ones which did not perform well, that will also inflate the performance since the poor funds have not been included. The third is survivorship bias. Since all the funds do not survive till end, the only best performing funds are going to survive in the end and are to be included in the hedge fund index. So which will create a survivorship bias. So all those who have been failed and closed down are excluded. So this leads to a situation where only success stories are there in the index and failures are omitted. So that will overestimate the returns. Fourth bias is due to asymmetric returns. So the some strategies may have unlimited downside potential and limited upside potential. So the returns are not very symmetric. So that will give you high amount of risk. So measures like standard deviation will not be able to account for this kind of risk. Fifth bias is smooth pricing. This happens due to the presence of broker dealer which will create their own price which may not reflect the true market price. These prices are just the estimates and not the actual price. And finally, this gaming is another bias of hedge funds where the managers are focusing on incentives. So they try to create a situation where their incentives are maximized instead of the returns for the investor. Let us move to the next concept, the legal concerns for closely held companies. So the companies which are closely held by certain investors and promoters and are not traded on the exchanges, they have certain legal concerns. Since shares are not traded, so there is no Security Exchange Commission regulation is applicable on them regarding their reportings or disclosures, etc. These companies could be partnerships, they could be corporations or sole proprietorship. For these companies, intrinsic value, fair value, fundamental value, etc. can differ among different jurisdictions since there is no one particular market value. So these values might be different. And open market transaction for closely held companies will be very rare. The valuation for these companies will be very challenging. Mostly it is based on actual past cash flows or forecasted future cash flows. Neither of them is completely reliable, but we need to go by these methods. Let us look at the valuation methods for such companies. There are three major approaches for valuation of closely held companies. First is the cost approach. So what is the cost today to replace all the assets of the company in present state? That is cost approach. Second is comparable approach, where we look at the value of another comparable companies. So we can have a comparable company or benchmark value, and relative to that we can estimate the value of the company. And third is the income approach, in which we look at the net present value based on the discounted cash flows estimated for the future. There are further adjustments which need to be made in the value. A discount has to be given if there is lack of liquidity as compared to a publicly traded company. So if we are comparing the value of a closely held company with a publicly traded company, then it has to be discounted for lack of liquidity. The second discount should be given for the minority interest in the company because of the lack of control of the management. Third factor should be considered is the premium should be given for controlling interest in the company, which is opposite of the second factor. And these discounts in the premium based on characteristic of the companies used for the base value. Now let us move to another kind of alternative investment, which is distressed security investing. So there are certain companies which are on the verge of bankruptcy, or they have already filed for bankruptcy protection. Their securities are said to be distressed. So there could be certain investors who might find value in those companies and consider that if investment is made at that particular time in those companies, they might survive and perform well in the future. There could be another kind of companies who are planning to avoid bankruptcy by entering into out of court debt restructuring. So they are asking their debt providers to restructure the debt so that they can continue with the business. In certain ways, these distressed securities are very similar to venture capital investment because both of them are risky, both of them are illiquid asset class, and the expected return are only over long horizon. The investors have to be heavily involved in both of them. Since it is a distressed security, the investor has to be involved in the management, and similarly in the case of venture capital investment as well. And a deep analysis is required in order to understand the future potential of the security in both the cases. Let us move to the next alternative investment, which is commodities. The investment in commodities give exposure to the investor in economy's production and consumption growth. So when economy experience growth, the demand of the product will increase and the price of the commodities will also increase. When the economy faces a recession, the opposite will happen. The demand for the product will fall, and accordingly, the price of the commodities will fall. So the swings in the commodity prices are generally related to the economic conditions, and these changes will be larger than changes in the price of finished goods. They are more volatile. The main motive to invest in commodities is to have hedge against the inflation in the economy. As we have seen, the price of commodities will change as the economic conditions change. So it is a good hedge against the inflation. Another motive could be speculation. Because of near-term expectations of the investors, they can invest in commodities. Let us move to the next slide. Commodity linked equity investments. There could be certain equity investments which are linked to commodity. For example, if shares of commodity producing companies are purchased, it is equivalent to investment in commodities. So if the price of that commodity goes up, the price of the stock will also go up. Similarly, there could be commodity linked bonds. They also provide an exposure to the commodity price. If the price goes up, these bonds will pay the return to the investor. They are based on single commodity, for example, oil or silver based bonds. there could be one more mechanism to have a position in commodities, which is collateralized commodity future position. In this situation, the investors go long on the future contract of that commodity, and in addition to that, he buys a government security like treasury bill, etc., where the market value of the future contract is equal to the value of treasury bill. So if there is any gain on the futures position due to rise in the commodity price, that can be used to buy more treasury bill, and if there is a loss on the futures position, that can be paid by selling the treasury bill. So total return of this strategy is going to be equal to the percentage change in the price of future contract plus the percentage interest which is gained by investing in government securities. So this is a combination of these two. Now we have reached the end of the topic. Let us take a few examples here. First question says,